I don't think it's okay. I mean, the presentation is not there. So essentially what has been allotted to me is pharma and manufacturing. And these are the two industries where one can see significant transfer pricing adjustments happening, because pharma is very intangible or technology driven, and also it has various legs of the supply chain, where cross-border transactions are involved. So pharmaceutical is one industry which not only in India but globally there have been decisions around the issue on transfer pricing. So it's an interesting thing to keep updating on what's happening in that industry. And manufacturing is general, so I would cover a lot of general issues, maybe focus on a few manufacturing issues like contract manufacturing, capacity utilization issues for manufacturers, those kind of things. But I think to make it interactive, most of you have attended various courses and now it's become like a seasonal thing, the study courses. So I would encourage you to participate, share your experiences and ask questions, because that will make it more interesting. So if you see the eighth slide on the pharma industry, there is a FAR analysis. So this is typically how the FAR analysis, it's a table which shows the functions, assets and risks. And this is the general functional analysis that you would see for this industry. Now the key and differentiating points in the pharma industry is on the manufacturing side. So manufacturing in pharma, we all know that there are two portions. One is the primary manufacturing and the other is the secondary manufacturing. So primary manufacturing is basically your active ingredient, and secondary manufacturing is your converting the active ingredient into formulation. Now API is the heart of the drug. So active pharmaceutical ingredient in the pharma industry is really the heart of the drug, and one needs to see who manufactures that, whether it is a researched API, whether it is a generic API. Those factors become relevant to understand when you are doing the functional analysis. The other important points in pharma is your intangible assets. So really for the purposes of manufacturing and the brand in which you are selling the drug, who is the owner of that intangible? And are you carrying out any marketing activities as the distributor of the drug, which is resulting into value addition to the brand? Because then it could give rise to marketing intangible issues. So those are some other aspects. And on the risk side, you have your R&D risk, which is crucial, as to who is really the company which is investing in drug invention, in new technologies, innovations, and who takes the risk of the failure, because to invent a medicine takes a long time. If it's a new medicine, if it's a generic, of course, it's by reverse engineering, so it's not that much of a process. And the other aspect is product liability. So, there are product liability risks, because in pharma, reputational and product liability risks are of significant importance, because any quality issue in the drug, could lead to impact on the reputation of the company. And I think most of you, would have read in the last several months about the US FDA issues on quality, and a lot of companies, Indian companies, manufacturing plants coming under the scanner, and closing shops, closing down those particular units, or non-acceptance of the goods in developed markets. So these are all issues one needs to be really aware of when you're going and doing a functional analysis of your pharma client. Moving on to the methods that are generally used on the next slide in this industry, typically you would see the cup, RPM and TNMM. So cup is essentially for purchase and sale of APIs, import-export of formulations, and royalty for use of technology and trademark. So again here, cup could be internal or external. And this has been really one of the key issues in the industry, which I will talk about as we move ahead. on when is a cup applicable, which situation cup does not make sense, what has been the position of the TP authority. Second is RPM. So generally when there is a buy-sell activity, like any other industry, but you see a lot of companies in India who just import and resell. You know, you have vaccine distributors, you have certain drug distributors, and they're just distributing and not manufacturing in India. Typically, in pharma, there is a startup phase. So when you start distributing goods, you know, initially for a few years, you could not make profits or you could even incur losses. So what is really the position one should take in, you know, these situations? I'll dwell upon it. But mostly using of the RPM method should be a good thing, because then you're restricting yourself to the GP margin, which really takes care of the transfer pricing related issues. And you know, if you're making a loss, it could be because of other expenses that you're incurring, you know, or some startup inefficiencies, or you know, your sales not picking up to the level of your expense, these kind of things. And then you have TNMM, where you could use TNMM for other transactions like, you know, contract R&D services, clinical trial services. Even for manufacturing, you could use TNMM, because not in all situations you would have a cup. So these are the methods that are used. Now going to the specific issues. One of the most interesting issues in the pharma industry that has you know, really been discussed in the last, I think maybe 4-5 years, since the time the UCB decision came out, you know, where they said that when a company in India is importing APIs, then whether you can compare the branded research API to the generic API. So you have this customs database that is available, and in this database you get, so if you are importing say a branded paracetamol, maybe say let's say a Combiflam, can you compare that with a generic paracetamol, you know, which is imported from China, Korea? Because the price differentiation of the import, if you see, in most cases could be significant. It could be 5 times, 10 times, 20 times, 100 times. So then, you know, the tax authority has gone into this thinking that how does it matter that, you know, it is researched and you know, that is generic, because at the end of the day both the drugs are curing the patient. Both the drugs are going through the FDA approval requirements in India. They are up to a particular quality level. So why should there be such a significant difference? You know, you can't have such a significant difference. And which is where the TPO started using the cup method, started using the customs database. Can I request you guys to come and sit this side? Because the place is quite empty. Because otherwise I have to keep looking for people. Sorry. So, if you don't mind, if you want to sit there also, it's okay. So, UCB was the first decision, and in the case of UCB, you know, the ITAC, the tribunal said that you cannot compare these imported imported branded research products with unknown products which are imported from China, Korea, etc. Because if you see the customs database, it hardly gives any information. It just gives what is the name of that ingredient, the generic name, the harmonization, the classification code, and it gives the price and quantity and geography. So it doesn't give the supplier, it doesn't give you know, whether the supplier is a distributor, manufacturer, what level in the supply chain he is, various factors. So ITAC said you cannot use it, and it set aside the matter back to the TPO and said that you should not do an aggregated approach. So what UCB had done was they had aggregated all the transactions together and done a TNMM. So the tribunal said that you can't do that. At the same time, you can't use the cup method. If you have exports, imports and services as separate transactions, you need to benchmark them separately under TNMM. But you can also not use cup. So that was one decision in case of import of APIs. Then you had a second decision that came about sometime in 2012, which was the Sardia pharmaceutical decision, where basically the tribunal members held that you should use cup in this situation, because in the facts of the case of Sardia, it was not demonstrated that the quality of the Sardia imports was significantly better than the generics. So in fact the tribunal went and said that just because one is generic and the other is researched or branded does not fail the cup method. So that is no reason to reject the cup method. One should look at the geography and various other factors, but cup is the right method in those cases, and it sustained or it upheld the TPO's position. So there were these two contradictory decisions that came up, and after 2012 there was a surge of transfer pricing adjustments around this issue by the TPOs, because in all other cases where this issue was not looked at, they started making using the cup and making this adjustment. Then I had myself argued one case in the pharma industry, which after the Sardia decision, before the DRP, and we had argued very interesting points. We had said that you cannot ignore, the price differentiation is one factor, but when should one use the cup method? What is the legal position of using the cup method? So cup can be used in a situation where the products are similar, and if they are not similar or the same, then adjustments can be made to make them similar. So that is the first basic requirement to use the cup method under the Indian law. And that test itself fails because you can't broadly make a statement and say that it's comparable. You prove the point that this quality wise it is, and you are saying that quality wise there are differences, but how do you quantify the differences? So that's really not possible. That is one. Second is you also need to look at basically that whether really that researched API is enabling the company to be in a market position where they're getting a maximum market share. So which means that because of that imported API, their drug is better, and because their drug is better, if they are commanding a high market share, not market share by value, but by volumes, because what happens is most of these branded products are high in selling price. So you don't look at the market share by value, but by volumes. But if by volumes also after the patent expiry regime, where everybody can come into the market and compete, the product is yet commanding that premium market share, then that shows that that product is unique as compared to a generic. And which is why you cannot apply Sardia, because Sardia, one of the basic things that it was relying on is that the products is not unique or is not superior in that sense. There is nothing to prove on record to say that it is superior or unique. So market share is one way in which you can prove. The second thing is you have license agreements, and this was one of the interesting points in the case of GlaxoSmithKline, the Canada decision. Where the assessing the taxpayer representative, the councils were arguing on the fact that in this situation, where an Indian company is importing APIs and manufacturing. So similarly in Canada, Glaxo Canada was importing, say from Glaxo UK, manufacturing in Canada, which means formulating in Canada and selling in the market. There was a license agreement. So the license agreement mandated the company to use the APIs of a particular quality and or buy the APIs from a source which is approved by the group in terms of quality. So if these kind of restrictions are there in your business arrangement, then how can it's like the TPO is trying to step into the shoes of the businessman and say that no, you should have imported a generic product. You should have used a generic product. One cannot do that. So if you are in that situation where you have this agreement and there is a compulsion because of this agreement, then the business arrangements become not comparable with that of the generic player. So these are some of the arguments that we gave before the DRP, and I remember DRP had Mr. Akhilesh Ranjan, who is a competent authority today, and he patiently, that family patiently heard the hearing, the 3 hearings, 2 to 3 hours. We got the business guys to come and explain how our product is different. One of the allegations that they had was that your product is different or you're commanding a market share because your marketing strategies are better. Your approach and reach to the doctors is much better. So we got the marketing guy and the business guy to come and explain that when we go to the doctor, what is it that we really show to the doctor, and what is that literature containing of, and what is the basis on which the doctor makes a decision. Of course, see, I mean, let's put aside the actual things. There can be some things that the doctors favor a few companies, etc. But without regard to that, as a industry, every doctor will have due responsibility to his patient. So it's not going to subscribe a drug. Today, when you go, and we actually gave examples of some of their high-end oncology, which is the cancer-related drugs that they were into the client. And we said that despite the fact that there are these competitors in the market, how the drugs are better, how the cardio drugs are better, how the diabetic drugs are better, and these are all very chronic diseases. You're not talking about an antibiotic. When you talk about an antibiotic like a paracetamol, maybe it doesn't matter. But when you talk about drugs which are chronic and critical in nature and which are consumed by the patient for a long duration, then it has an overall impact on his life. So even if there is a 2% differentiation in quality and the patient can afford that drug, the doctor has to make that available to the patient and say that these are the options available. This, in my view, is technically a superior drug. This will also achieve you a similar result. This is the price differentiation, and this is how actually you really, the doctors decide on what is the drug based on the affordability, based on the criticality. All these things they understood very well, and they actually deleted the adjustment. They deleted the adjustment. Unfortunately, the second year, the TPO did the same adjustment. Again, despite of the DRP giving a favorable order, and the TPO strengthened this order as compared to the first year. And the second year, DRP gave the ruling in favor of the TPO. So the point really is that this is a very, very critical issue as far as pharma industry goes. I think all of us are waiting to see what happens with the Sardia decision to the High Court. The case is admitted because it's a matter of law, what method to use. Of course, it is very fact driven, but even when can a cup method be used under the transfer pricing provisions, and whether it is jurisdictionally correct for the TPO to apply the cup method. So those questions are before the High Court, and I think it will be interesting to track this entire issue because this will really define. And in the midst of all these issues, in the last 1 year, you have a fate of newspaper articles which talk about how the generic drug plants have been shut down, why they've been shut down, what are the quality issues. So not to say that that the Indian pharma companies or the generic manufacturers are all in one boat, but it is not a situation where you can blindly, it's not like a commodity, like a gold or a coffee or something, where you can just compare an apple to apple or a red apple to a green apple. It's like actually comparing a grape to an orange or a apple to a mango. So that is really what you need to understand and apply in your TP provisions. So that is one issue. Second issue in the pharma industry is on the payment of commission. So the pharma industry, this is another common transaction that comes up. There are canvasser arrangements. So what happens is that a lot of pharma companies have export canvassers in Russia, Ukraine, Middle East, a lot of these central hubs where they export to them, and those companies do the marketing and distribution and get orders, and the Indian company pays a commission. So this commission in a related party transaction often can be camouflaged, is the suspicion of the TPO, because they believe that substance over form is not there. Though there is a canvasser agreement, it is just a paper company, and you're just trying to shift profits by way of giving commission to that entity, unless and until you are able to demonstrate that the Indian company has received services of marketing from them, how is the sales increase, what is their marketing effort, what is the services rendered, and what is the benefit derived by the Indian company. So there have been a lot of disallowances in this area. I think the crux of the issue in this transaction lies in your documentation. So if you are able to demonstrate that you have benefited because of that canvasser arrangement, and you added new customers, there's a lot of marketing activity that they do in terms of holding conferences, printing out promotional brochures which are localized to that particular jurisdiction. All these things could help in demonstrating that actual services are rendered. One cannot question, again going back to the commercial expediency argument, to say that why is there a need for such an arrangement. So the TPO can't really go into the steps of the businessman, but the TPO or the AO can definitely challenge that the payment of commission made, is not for the purposes of the benefit derived by the Indian entity. So that is what you really need to tackle in this transaction. Then moving on to the next transaction, clinical trial support services. Now here there was, I think, an interesting case in the case of Zydus Altana Healthcare, where the basic issue in case of clinical trial that takes place is, a lot of companies overseas outsource clinical trial work to Indian companies. And clinical trial has various phases, so it's the last phase of R&D. And within clinical trial also there are various phases like phase 1, 2, 3, 4, post-market surveillance, testing of the drugs finally on the patients. So what the Indian hubs really do in majority of the cases where this issue is wrecked up is it coordinates the efforts with the hospitals. So the actual clinical trial is conducted by either hospitals or it is conducted by contract research organizations. You have a lot of organizations like your Vimta Labs and Choksi Laboratories and a lot of these companies who do actual clinical trial services, who are CROs, who are called as CROs, contract research organizations. And these companies, what Indian subsidiary does is really coordinate with these companies. So it's not actually doing clinical trials, but it is shortlisting the doctors, hospitals, and doing that logistics with them. So what the TPOs have done in a lot of cases that have come up to the tribunal are that they are treating the Indian company as full-fledged clinical trial companies, and they are levying high markups of cost plus 25 to 30%, which you would typically see in a clinical trial, when you do a benchmarking for clinical trial companies. But what really you need to benchmark is the coordination activity and not the clinical trial activity. So the benchmark has to be more of coordination back office kind of companies and not the high-end clinical research companies. So the Zydus Altana case really settles this position because it says that whatever. So the Zydus Altana case really says that the pass-through expense. So there are two expenses in the Indian company's book. One is what it is actually paying on a back-to-back basis to the hospitals, which is pass-through. There is no value addition that you are doing. There should be no markup. It's a pass-through, and only for your bit of service that you're doing for coordination, there should be a markup. So this again, it depends a lot on how you document it. Your intercompany agreement is very crucial in this transaction. So if your agreement of clinical trial support with your parent company does not bring out all these facts that you're only a coordinating arm and what you're actually doing, and you generally were saying that clinical trial support, then you could land up in this situation. So your agreement drafting has to be very crucial in this. Moving on to the next issue, you have marketing intangibles. Have you covered marketing intangibles? Not yet, no? Okay. So, marketing intangibles is a general issue actually which would be relevant for any industry in that sense. Typically an industry where marketing is required, like pharma, FMCG, you have your retail, consumer, manufacturing. The crux of the issue in marketing intangible is the allegation, let's start with the allegation that the TPO has, and it's not TPO actually, it's a worldwide thing. So it's really started from Glaxo and DHL and some of these other decisions which define the bright line concept. So what they say in this case is that if a distributor is marketing certain products for its associated enterprise or parent company, then if the marketing activity is extraordinary in nature, it's not routine as a marketing agent or a distributor agent, but the expenses incurred are higher than what other companies in that industry would incur, then that excess has resulted in a brand enhancement for the parent company or the owner of that IP. And so it's like a de facto service that you are rendering of brand promotion. So you should recover those excess expenses, which is the bright line, excess and above the bright line, with a markup. So this is really the issue in case of marketing intangible. The first issue in the Indian transfer pricing landscape came out when Maruti Suzuki was decided. So that was really the first issue where they said that Maruti and Suzuki have a tie-up, and Suzuki is piggybanking on the Maruti brand name to enhance its own brand, and therefore the royalty payments that were made by Maruti are really not tenable, because in fact Suzuki should have paid a royalty to Maruti because of the brand being associated. And second, they said is that the extraordinary expenses incurred by the Maruti Suzuki company in India should be reimbursed by Suzuki with a markup because their brand is getting enhanced. So that was the first issue that got triggered. Then a number of such issues, the adjustments started happening, and different benches started taking different views. So there was a special bench which was set up to decide the case of Maruti Suzuki, which was in the case of LG Electronics. And there were interveners to the bench, where a lot of companies having similar issues argued the case before the special bench. And the moot or the basic point before the bench was that, is it an international transaction? Because there were a number of decisions which said that this excess is not an international transaction only. There is no arrangement with the AE to do this. And the TPOs do not have jurisdiction or power to really impute a transaction. So this is not a transaction, and second, it is not even referred by the AO to the TPO. It has just come up during the TP proceedings, so he does not have any jurisdiction. So these are some legal questions which were raised before LG Electronics, and LG Electronics basically, heard the argument. They were supposed to give the argument only on law, but we really went into the facts of the case and confused the whole matter, I feel, because marketing intangible is a very fact-driven thing. You can't, but because of some principles that are now laid by LG Electronics, it is being followed by all the other tribunals. So the LG Electronics decision said that yes, it is an international transaction. TPO does have jurisdiction. There is a service rendered, and therefore they accepted or gave a kind of a stamp to this bright line thing. And one of the other questions was that this bright line is really no method under the Indian law. So what method do you say? So they say that cannot be, just because it doesn't fit into any of the methods, cannot be a reason for it to not come under scrutiny of international transaction, and which is where then this whole thing of other method had come in, the sixth method, so that you can actually address any transaction which doesn't get covered under the five methods and other method. And they said that the cost plus, so the bright line is not a method, but the bright line is only a methodology to compute the cost. So the cost in excess of routine marketing. And then there is a plus. So in that sense, it's a cost plus or the TNMM method. And we are really not talking about the bright line method. Then after LG, there was a decision in the case of BMW. And BMW, so LG was a licensed manufacturer.